Good morning and good afternoon, everyone. My name is Magnus Gruvman, and I'm the CIO here at Moonfair. Some eagle-eyed viewers may have spotted that it's Magnus hosting today's webinar as opposed to our founder, Stefan. Stefan's unfortunately unable to join today, so I'll be taking over in his stead. Um, I'm really thrilled to have Jason Thomas, Carlyle's global head of macro research, here with me today. And first of all, thank you, Jason, for joining us. It's a true pleasure to have you. Why am I so excited to have Jason on today? Well, I think Jason and his team have a capability of taking very high level macro analysis and really translating it into what impact this will have on tangible items like companies, business models, valuations. And I presume that's also why they are so valuable to Carlyle partners in the work that they do. We'll talk a little bit high level about where are we in the macro environment today. We'll cover the United States, Europe, and also dive into a little bit where China is. Obviously, the elephant in the room in today's macro environment is a lot of what's happening in the banking sector over the past couple of weeks. And Jason, when we planned this webinar, I know it was 3-4 months ago. We didn't really know what timing this was going to be, but obviously, for me, an exceptionally well-planned timeline for us to talk through all of these issues. And I'm sure that a lot of our participants in today's webinar will be very excited to hear your views, both on the broader macro situation as well as the SVB and the banking sector. After that, we'll go into a little bit of tying those macro topics into what is the impact on private markets, private equity, financing, companies, business models, which is, I think, where you and your team's analysis stands out compared to others. And then towards the end, I'll also ask you a little bit to look into a crystal ball and see where are we going from here? What should we expect from the rest of 2023? And assuming that we manage to stay on time, we should have around about 10 minutes for Q&A towards the end. So for everyone online, if you could please think of interesting questions and submit them, and we will try and go through as many of those questions together with Jason as well towards the end. Excellent. So then without further ado, obviously we've already hinted to it. 2023 has kicked off with a couple of curveballs. It's been positive news and negative news and ups and downs in the markets, and a couple of challenging weeks in the banking sector. So at the highest level right now, what do you think, Jason, especially in the US market? Is it fair that, markets should be a little bit surprised and continue to see this type of volatility, or are we having smoother sailing ahead of us? What are your thoughts?
Well, it's a time of really remarkable uncertainty, of course, and I think it's important to start with when you look at the macro situation in the U.S. I think there's a before and after dynamic, which is to say, certain point of view or expectations that one may have had as of March 8th, and then a new set of views based on what we've learned over the course of the weekend and with the failure of SVB on Friday. And so first, when we look at our portfolio and look at the dynamics and look at the monthly performance indicators from over 200 companies, what we saw, of course, not surprisingly, was inflation remaining much stickier than people had hoped. And I think that the big question was really how much would inflation decline naturally from healing of supply chains, which we'd seen. When you look at shipping costs, when you look at delays in delivery times of components and parts, when you look at the number of ships in port waiting to be offloaded, all of these metrics had really returned to 2015 to 2019 averages. So that source of the inflationary spike is really behind us. So there was a lot of optimism that inflation would then trend down to target. In addition, you had a normalization of spending patterns. one of the big reasons inflation spiked was because people were spending money on things the underlying economy was not designed to produce. So they took down their spending on experiences, travel, tourism, live events, dining out, of course, during the pandemic. But then this was offset by a massive boom in durable goods spending. Things like patio furniture and appliances and home electronics and those sorts of things. So it's very easy for a household to take money that was going to be used to go on a trip or cruise or something of that sort, and then spend it on a new car or a used car or against some other durable good. But of course, the underlying economy cannot magically transform uh, that unused cruise ship capacity into durable goods. So that was again always going to be shortages and price pressures, and that also again is largely behind us. If you look at the level of spending today, almost exactly what one would expect if you were to linearly extrapolate spending trends from 2015 to 2019. So those signs were suggesting that inflation should come down naturally. It hasn't. And that's the challenge. And so the expectations in markets were that the Fed was going to have to take rates to about 5.7%. So another 100 basis points from where we are. And there was starting to be this begrudging acceptance that rates were going to have to remain at these elevated levels for much longer than previously thought. I mean, it was at the start of the year, or I guess at the end of January, there's expectations that the Fed would be able to start cutting rates in the second half of the year. And as the data came in, that became much less likely. So I think it was really markets that were, because of the strength of the economy, because of the strength of the consumer, because in particular, the strength in those experiences categories that were so hard hit during the pandemic. And our data were indicating 25% increase in spending levels on those travel, tourism, live event categories relative to 2019. So pretty impressive growth on an annualized basis since then. Leaving aside the meteoric rise from the lows of the recession, because of the strength of the economy, the expectation of continued inflation, there was again the rate environment was going to be a huge headwind, and I think people were coming to terms with that. Then you have the failure of SVB, and what I think and SVB is very idiosyncratic. So first of all, when you look at the bank, they had about 65 billion of deposits as of the onset of the pandemic. So say the March 1st, March 10th of 2020, that grew to 191 billion as of the year end 2021. So in that just 22 months, you had a threefold rise in deposits. I mean, this, sometimes we shouldn't overthink this in some sense. Just when you have a financial institution that grows that rapidly, of course, there's going to be heightened blow-up risk. And I think that, so in some ways it's that simple. It really is. But this, of course, was largely related to and could not have occurred were it not for the hundreds of billions of dollars of capital that had been channeled to that Silicon Valley ecosystem during the 2 years of the pandemic. In addition, so there is a tech element here that is more generalizable, and we can discuss that. In addition, there is something that is generalizable to the banking sector, which is very large fair value losses on fixed income securities. So SVB, when it grew so rapidly, no way to scale up your loan book proportionally to the increase in deposits. So of course, they invested in high quality liquid assets, largely treasury securities, and then agency mortgage-backed securities. But they were buying these securities, of course, 2020, 2021, when interest rates were at all-time lows. They didn't have hedges in place for those assets. There was certainly a risk management failure as relates to that interest rate risk. And so when they had to sell these assets to meet the surge in withdrawals from depositors, they were trading at 80 to 85 relative to those par values. And the size of those fair value discounts, they had to crystallize at those sales, and that left them undercapitalized. And so when you look at the banking sector as a whole, there are quite a lot of fair value losses on these securities. The banking sector in the United States holds 1.4 trillion in treasuries. It holds about 2.8 trillion in agency mortgage-backed securities. In addition, there's about 5.7 trillion of mortgages more generally, whole loans that are held on the balance sheet that are also rate sensitive. So the Fed, seeing that, again, very lots of specific factors, idiosyncratic factors, also recognize that other banks, if forced to crystallize these losses, if forced to sell, would find themselves in a similar situation. So they created a backstop. And as you saw yesterday, the Fed announced that its balance sheet grew by $300 billion over the past week. And so they lent 150 billion roughly to banks that were scrambling for liquidity last week. They lent 11 billion in this new one-year term funding program, and then lent another 140 billion or so to the banks that failed just to meet their needs in the interim. So right now you have a situation where on the one hand, it's reasonable to be concerned about some of those panic psychological dynamics as people start to worry about the security of their counterparties, worry about the security of their deposits, and that's a risk. And certainly the volatility in rates markets suggests that there are a lot of people concerned about this and the potential for a panic and potential economic downturn as a result. But on the other hand, and why I think the risks are more symmetric than people suppose, you now have, instead of a central bank that is tightening aggressively to deal with this much more persistent inflation that we discussed, you have them massively expanding their balance sheet to try to backstop the banking sector. So as a consequence, one of the risks that I think people need to be conscious of is that financing costs actually are higher at year-end 2023 and year-end 2024, precisely because the central bank has to pivot to provide this liquidity, to expand their balance sheet, to backstop the banking sector, which means they cannot deal as forcefully with this persistently high inflation.
So I mean, if I understand you correctly here, essentially we're pushing the gas and keeping the handbrake on a little bit at the same time. So essentially, looking back to end of Q3, Q4, I think people were fairly in consensus when it came to, look, the U.S. economy will manage to turn this around without going into a recession. Inflation seemed to starting to curb. Since then, we've had a couple of inflation surprises. We've had jobs coming in stronger than expected on a number of occasions, which has led to additional rate hikes from the Fed to try and curb this inflation. Now, because of what's happening, we have more money flowing into the system at the same time. Do you see that risk of going into a recessionary environment as increasingly high?
I think the risk of recession is clearly elevated. So again, this is a very complex environment because of, as the analogy you suggested, driving with 2 feet, the brake and the gas simultaneously. So this injects quite a lot of uncertainty about the outlook. But I do think that when we look at debt service costs, when we look at the cumulative impact of this rate shock on bank balance sheets and banks' willingness to lend, and also, of course, in some ways, the tech sector has been this canary in the coal mine, where much of the economy shows signs of labor hoarding. So some of the improved job or better than expected job numbers, not necessarily hiring, although hiring is still very, very strong in those services sectors where travel, tourism, live events, restaurants, bars, still about 1 million jobs fewer than 2019, even as business volumes are actually well above where they were at that time. So still a lot of hiring and wage pressure there. But much of it is the experience trying to scale up your labor force after the pandemic. It was so difficult for businesses to find workers, almost at any wage. And so I think many management teams decided that rather than have to go back into the market and relive those experiences in 12 to 15 months when the economy is reaccelerating, it's better just to hold on to those workers, accept somewhat narrower margins in the short run, and then again not have to go through that difficult experience again. So that's a big part. But the exception to this had been tech, and the tech sector had announced about 300,000 layoffs thus far. Only about 30% of that is the mega cap tech stock, so it's very widespread across the industry. And I think a lot of it is a response to higher rates. It's a response to the rates making some of the business models less attractive, and we can talk about that, but also some of the financial distress, just leverage that looks very low on a loan to value ratio. So the debt is a relatively small share of the entire capital structure, but if it's floating rate and you paid very high multiples, that means that the interest now, the debt service costs, are consuming virtually all of operating income. And as a result, there needs to be cost-cutting, layoffs, and other steps taken to ensure that there's sufficient operating income, cash flows to meet those debt service costs. So this phenomenon that we've seen in tech, I think the expectation is that it would start to broaden across the economy as rates increasingly bid. Now, this is again a situation where it could be that rather than having this downside scenario, this panic, because of the risks in banking and perceived risks and some of this panic psychology, because of the backstops, because of the liquidity injections, that you actually avoid recession, but at the same time, we end up having a much more protracted and challenging fight with inflation.
Absolutely. I'd love to dive in a little bit deeper on this point that you mentioned about what the interest rate impact is going to be on specific sectors and companies, because I think, as you rightly point out, to date, the main impact on financing has probably been more on the new deal side than on the actual sort of operating side and running of businesses with the higher cost of financing. But maybe we save that just a couple of minutes. Before we go there, I want to switch gears a little bit and talk also about Europe, because obviously it's a very different environment, and also the reasons for inflation. You mentioned sort of the broken supply chains as a key component in the US. I think in Europe, obviously with the war and the impact that that's had, and also the impact on energy prices, inflation's been seen on both sides of the Atlantic, but drivers have been different. So I'd love to hear your thoughts on, what are you seeing in Europe today? What's the picture here compared to that in the US, and what are potential additional challenges that Europe are facing?
Yeah, so I would say, first of all, when you look at economic outperformance relative to expectations, Europe has outperformed more than any other economy. And so if you go back to August and you looked at the 11-fold increase in wholesale energy prices, if you were to just run that through corporate income statements, run it through the household sector and the likely impact on consumption, you would have expected a fairly deep recession. That didn't happen. And I'm very impressed from our data just how resilient the household sector and consumption has been. And of course, there's many reasons for this. Mild winter is cited, but I think the number one reason is, of course, subsidies. European governments have been spending between 3 to 7% of GDP. I think the cumulative total now is about 800 billion euros to ensure that spike in wholesale prices does not flow through to the household sector, to some businesses. And so that's been something that I think the scale of the policy response was unanticipated and has really blunted the impact. There has, of course, been some casualties when you look at the industrial sector, but specifically, if you look at base chemicals, that's down 16 to 20% in output. This, of course, depends on natural gas as a feedstock. So when natural gas is either unavailable or priced at much higher costs, it makes some of those processes uneconomic. And so there has been a big pullback there. But the success has been localizing the pain so that it hasn't been this more generalized shock. And I think that we saw the ECB continue to hike by 50 basis points. We'll see going forward. They, of course, were much less hawkish given the challenges in the banking system more broadly. And I think that we have similar dynamics insofar as one would have expected the central bank to be much more aggressive about inflation remaining persistently above target. And now these challenges open the door to the ECB, perhaps even being done with its hiking cycle. We will see. So in general, again, I think it's and beyond the subsidies, you also have a willingness to switch to coal, which is terrible from a climate perspective, but it has ensured that the lights have stayed on. Europe went from consuming 8% less coal than the United States to consuming 6% more as of last month. So that's been a big swing. Again, very, very damaging from a climate perspective, but it has lessened the near-term economic impact. And then you also have the speed with which some of these floating LNG terminals, of course, particularly in Germany, have been put online. And that is, the first LNG terminal was approved in July of 2022, and it's already was in operation January 7th. And so this has helped. So it's really, I do want to credit, this is not just a mild winter. I do wish to credit policymakers. I think the question going forward is how long, of course, these subsidies can remain in effect. How long can these fiscal deficits remain elevated, particularly in a time when finance costs are so much higher than they had been for much of the past decade.
Yeah, and I mean, in addition to what you're mentioning on the pure cost of running these deficits, are we also just kicking the can down the road in terms of continuing to fuel inflation? So despite the fact that we are pushing up interest rates to try and curb the inflationary pressure, are we at the same time by sort of injecting all of these subsidies into the system, is that going to mean that potential or past rate hikes and potential future ones will just have to be a little bit more aggressive, or do you think that the cooling down of the economy will be enough to sort of counteract it?
Well, I do think that first there is this symmetry of risk. So people that are focused solely on the downside, the potential for a banking panic, the potential for recession, need to understand that there is also this upside risk where the economy performs better, but again, more protracted challenges with inflation. But specifically to the fiscal side, I think that the real answer to the question about fiscal sustainability, of course, it has a near-term impact, upward pressure on inflation and economic activity. But the question is whether this is a bridge to new energy sources. And if so, then this is perfectly appropriate. If you're just buying time to diversify your energy sources, to move away from Russian natural gas, and in 2 years, because of investments in renewables, because of investments in LNG, because of some of the fuel switching that we mentioned, that you're in a materially better position, well, then this was money well spent. If this is just subsidies that really last in perpetuity, well, now you're starting to actually substantially increase risks over time. So I think that we'll see. But again, the fact that I have seen not just subsidies, but also a conscious effort to diversify fuel and energy sources makes me feel that this policy mix is roughly appropriate. It's not what anyone would pick, but given the contingencies, given Russia's invasion, it seems to be again a fairly reasonable approach to a complex problem.
Excellent. Yeah, that's really interesting and also very insightful. Thank you for that. If we switch gears a little bit, and I want to talk about sort of what impact the current environment and where we are in the cycle will have on private equity as a whole, on the debt financing and deal making and also exit environment. But maybe before we transition into that, it would be interesting, I think, for the listeners to get a little bit more of a view of how do you work together with the investment professionals at Carlyle? What are the different roles that you and your teams have I know there's more than one, so maybe if you could just tell us a little bit about that, I think it would be good for putting a little bit of context to the next section.
Sure. So I joined Carlyle about 12 years ago to come in, and my training is in financial econometrics. So it was to take a more scientific approach to the data that's generated by our portfolio companies, and really to try to separate what is idiosyncratic or specific to the business from some of the performance that is macroeconomic in origin. And so what we do is essentially algorithmically weight incoming monthly performance data from the companies based on its sensitivity to macroeconomic aggregates like GDP or retail sales or industrial production, and then look at what those incoming data suggest about trends in the economy across these spending categories, across geographies, for maybe the next 3 to 9 months. Of course, beyond that, things get more challenging. And as we've seen with the pandemic and other shocks, it's just challenging to forecast 2 weeks into the future. But in general, it's to again make those sorts of assessments about what the data are telling us about the broader economy. Then to use that data and information to help inform investment decisions. Of course, that's also exits. If you see a downturn or you see a weakening that is not yet fully appreciated by market participants, you can accelerate sales processes. But then also to think about some of the secular growth drivers. Sometimes when companies and industries that are growing in ways that don't really exhibit that sensitivity or GDP dependence, and to think about how to price that relative to some of the more cyclically sensitive companies. And in some cases, you find that cyclical sensitivity is more an impression than an empirical reality. So I think that can help as well. And then also just when you think about underwriting scenarios and expectations, sometimes the company is going to outperform because of the management team, because of the specifics of the business. But the question sometimes is how large is outperformance? How reasonable is it to assume a 800 basis point or something expectation as a seller is sort of suggesting is reasonable over the next 5 years? So it's a way to think about the economy, a way to think about some of the assumptions embedded in underwriting scenarios, and I think make better investment decisions as a result. And of course, this is coupled with information that is coming from public sources. It's relating again our data to some of the aggregates that are reported by official statistical agencies. So it's really again trying to provide the macroeconomic lens to what is inherently a micro business. The deal making, the specific companies, the relatively small portfolios that in terms of number of companies, number of assets. And so I think it's an overlay that improves investment performance decision making, and again helps to separate what is actual risk or growth exposure from what is genuinely the company specific attributes.
Excellent. Yeah. As a next step, I'd love to dive in a little bit to what you mentioned before about sort of the interest rate hikes having had so far predominantly an impact on the tech sector due to the high valuations there, but that we haven't maybe seen the full flow through of those interest rate hikes to the commercial sector. And where am I coming from here? I think over the last 6 months, we've definitely seen significant impact on household spending and a number of other areas. But when in the sort of deal-making sense, we talk about interest rate hikes or where we are in the financing markets right now, predominantly what we hear is that deal volumes are down, not just because there's a bid-ask spread between sellers and buyers, but also because banks in the volatile environment that we've been in have been struggling to either price something or maybe just been a little bit more reticent to provide financing and significant amount of financing to deals. So I guess that's a two-pronged question a little bit. First of all, where do you see financing markets going? There's a seems to be a pent-up demand in terms of deals that people want to happen. That bid-ask spread is shrinking. Do you think there will be a financing market available that will drive up deal volume over the next 12 months? And also then, rather than on the pure deal making, on an operating perspective, what do you think will be the impact on all those companies that may not have swapped their rates, but will be having increasingly higher interest rate costs over the next few months? Is that going to spread from just the tech sectors down to also other sectors with lower valuations? What are your expectations on those two topics?
Yeah, so thank you. I would say, first of all, in terms of deal finance, it is really all about private credit and private markets right now. So banks have pulled back. A lot of that is risk aversion. A lot of it is trying to avoid an inability to syndicate loans. Of course, the scrutiny that these banks face from regulators means that the more aggressive they are in terms of extending deal finance, the greater the risk they face of not being able to pay dividends or having their repurchase programs curtailed. So I think that they're very much focused on managing those risks and not taking undue risk that is, again, whether they think it's risky or not, that is going to be looked at suspiciously by their regulators. So I think that that's a dynamic that is going to persist, given what we've seen in banks and the worries about some banks' balance sheets, at least, again, the fair value if they're forced to crystallize some of these losses and these highest quality liquid assets that they hold. I also think that it's very obvious, not just private credit that is the main source of deal finance right now, but also the mezzanine portion of the capital structure is increasingly important today. And that is to keep the interest burden relatively low on the companies. You need a source of deal finance that is willing to pick or to have a warrants or upside participation that does not demand current income, that does not demand an increase in interest burden, because of course the private credit is now 9 to 11% for the senior secured loan. So it's up about 70% relative to what you'd see as a typical interest expense just 14 months ago. And I think that portion of the capital structure from an investment perspective, that mezzanine, is very attractive today for investors. You can get 14% to 16% yields, and generally it's, again, deferred. So that's on exit or at some point in the future, or again depends on company performance. But that to have that much equity in many cases sitting below you in the capital structure, to have that sort of security relative to the enterprise value and still earn 14% is very attractive. Of course, that means that there is some dilution to the ultimate equity upside, but less so than if you just had a much larger equity check, which of course is the other option in today's financing environment. So, I think it's hard to.
These are predominantly, you said, pure PIK structures today, or is there some cash component to it when you're talking about these 14%?
Yeah, I mean, it's a deal specific, but yes, the 14% in many cases is just purely PIK. Yeah. So you have a fixed rate at which it's compounding, and that is your essentially liquidation preference at exit. Yeah. But there is also, of course, in other situations, you can get maybe 2 to 4% coupons, and then in exchange for some warrants or other ways to participate in the upside. So it depends on the deal. It depends how it's structured. It depends, of course, on the preferences of the fund that is providing the mezzanine finance. But it is it's probably the most interesting part of the market today, I would say.
Yep. And then if we switch gears a little bit more into sort of the pressure that these cash payments will put on P&Ls over the next couple of years. You mentioned the cuts on the job side in the tech sector driven by those high valuations where the loan to value looks relatively low, but the cash cover on the interest side is something completely different. Do you think that these interest rates will continue to bite also in other sectors and push companies to make adjustments to their cost structures, or is it predominantly in that really high valuation environment?
Well, right now it is concentrated in that high valuation environment, and I think it will broaden. But first, just to take a step back, I think what is especially fascinating about thinking in terms of debt service costs today is that when we think, or when someone says financial distress, it immediately conjures images of troubled companies, zombie companies, companies that are in declining industries. And today, actually, the financial distress is most elevated in the fast-growing companies in the ascending sectors of the economy. So if you look at next 12-month debt service costs, cash interest coverage, and also some pricing data, distress is most prevalent in industries like software, in IT services, and some medical technology. And why is that if these companies are performing so well? Well, it's simply because of the entry multiple, that the more you pay for a company, that means that the less cash, less EBITDA per unit of enterprise value. And what we found in 2021 is that these capital structures had much more floating rate debt than they did fixed rate bonds. And if you look at tech specifically, there was 6 times as much floating rate debt as there were fixed rate bonds in the capital structure. And that ratio was much higher in the tech sector than anywhere else in the economy. Now, of course, much of this could have been swapped. That's, we don't have those data. So there's, you sort of have to rely on anecdote, but I do get the sense that not as much of this was swapped as people would have liked given the move in interest rates. There was a sense that many of these businesses, because they're growing so fast, could grow their EBITDA faster than the Fed or other central banks would hike interest rates. And as it turned out, that it was the opposite, where the EBITDA growth has lagged relative to this historic hiking of rates. And so as a result, you have lots of businesses in this space that are not at risk of default at maturity, which is usually how we think about it. We look at when maturities are arriving and we think about default in that context, but actually at risk of payment default. And as a result, rather than focusing on growth exclusively, now have to, as they say, turn growth off to start to actually generate the operating cash today in sufficient quantities to meet those interest payments as they come due and avoid the payment default. And then the issue is, what does this do to valuations? One could imagine a scenario where the company's growth falls so rapidly because of these efforts to generate cash that now the multiple has re-rated downward and the equity is effectively worthless at this new implied multiple. So this is going to create challenges, but also opportunities, and very much same vein, some of these mezzanine securities where the capital structure needs to be reconfigured given the much higher debt service costs. And as a result, there could be a third party to come in, pay off a portion of that debt, reduce debt service burdens, and then allow the company to resume growth. Of course, that provider of capital is going to participate in some of that upside. So there will be some dilution to equity, but of course that is much better outcome than a payment default or a re-rating that causes the multiple to fall where the equity value declines. So I think this is really, again, a very, very interesting part of the market and thinking about capital structures designed for a world of zero interest rates and how do they become reconfigured to deal with this much different financing environment. That is going to be a big issue in 2023, 2024, because maturities and the maturity wall really does not bite until 2025, 2026. I do think we have some time to figure these things out. But I do expect quite a lot of activity in that space. And yes, as rates rise, as rates have to remain higher for longer to deal with protracted inflation, this will spill over to more and more sectors. But again, at the outset, very much concentrated in those places where, because of very high valuations, there's just a very low cash yield on the assets, and as a consequence, cash interest coverage ratios that are very close to 1, if not have already breached below it.
So to summarize, we've got a maturity cliff that for the majority of the industry is relatively far out. We're assuming that most of these are cov-lite or no covenants, but it is actually getting to a point where just the servicing of the cash interest is starting to impact the companies. And as a result, rather than focusing on just growing, these companies have to focus on their cash generation, on profitability in the shorter term, which I guess from a sector perspective, it may not necessarily have to be purely a bad thing. But if we've got these high quality companies with a little bit or a lot bit of a sort of bad capital structure, many of them, I guess, will then, by focusing on profitability rather than growth, manage to get to a more manageable setup, and you might actually end up with more stable companies at the end of the day. Is that a fair summary, or?
Yeah, no, I absolutely. I mean, I think that we saw over the past couple of years excessive focus on growth, because that was how you expanded your multiple. Or, of course, it's how you prevented your multiple from contracting. So I think there's evidence of some uneconomic decision making, because rather than maximizing profits or even identifying the profit maximizing growth rate over time, there was pressure to maintain that top line growth, because that's essentially what the market demanded during this period of extremely low interest rates. And so now it's changed. And you see this, of course, in public companies as well. When you look at the analyst calls and the quarterly earnings calls, it used to be, where's your growth coming from? What are the metrics I can look at to measure subscriber growth or growth in the revenue base? It was just very much a growth focus from the analyst community and investors more broadly. Today, as you saw in the Q4 results and earnings calls, there was this newfound focus on margins. How do you make money today? What are you targeting for your operating margin today? And that has contributed quite a lot. In addition, I think when we look at interest rates for many businesses or projects, so if you have mega cap companies, just new projects that they're launching very often require very significant upfront costs to create those valuable intangible assets, proprietary technology, new software, new therapeutics, those sorts of things. So large losses in the short term, but then payoffs that can be really immense down the road. Just very, very attractive scale properties where you can grow revenue without much in the way of incremental hiring, incremental investment. So those very attractive projects, but that's very rate sensitive, both because the opportunity cost of funding losses today depends on the money market interest rates. If money market interest rates are zero, you're much more willing to fund losses today than when money market interest rates are 4.5%. All of a sudden, you have real options for your money. Just burning that cash doesn't look so attractive. And then, of course, the payoff in the distant future. When long-term interest rates are 1% below, obviously in Europe, negative, well, then those long-term payoffs are worth much more in present value than when interest rates back up and those longer-term yields. So the increase in longer-term yields has also diminished the terminal value of those distant cash flows. And so this again has changed, and it's put a premium on an ability to generate free cash flow today. And yes, I think that this is good, because it means that we're rotating away from some of that uneconomic decision making focused solely on growth. But of course, it will create some near-term challenges for some of these companies that may have a capital structure that was designed for a different era.
Absolutely. Thank you. I think both you and I find this super interesting, and we could probably continue talking about this for much, much longer. I do have two more questions that I really want to get in, and then we also want to have time for Q&A towards the end. So if we can hit these two a little bit more high level, and then we'll open up for Q&A, that'd be amazing. First of all, last year, your team and you did a very, very interesting analysis, I find, where looking at what looked like very, very frothy valuations across the public markets, you broke that down into sort of three segments: the the highest valued companies, the mid segment and the bottom segment. I hope I'm not bastardizing this too badly. But essentially, the findings, if I remember correctly, were that the top segment were significantly overvalued compared to historical valuation multiples. The mid segment was somewhat overvalued compared to what that segment had historically been. And the bottom segment was actually undervalued compared to what the bottom segment had historically been. And obviously, the sectors that we've all been really excited about over the last few years with B2B SaaS software and so on, we're sitting in that top sector. Where have you seen this going since? Has the correction of the market predominantly been in that top third of significantly overvalued companies? I.e., have we had a compression where the dispersion has gone down? Or was the dive across the board sort of the same, so that those lower end companies that were actually already undervalued also continued to go down? Do you have an update on that?
Yeah, so it is as one would expect. If you look at full year 2022 and then the first couple of months of trading, and this is, again, public markets. This will eventually, I think, be evident in private markets, and we see the first signs of that as well. But if you just take the 20% of companies that are the value companies that generate the most free cash flow per unit of enterprise value, they were actually roughly flat in 2022, down slightly. And if you look at dividend paying companies, the top 10%, not only generating free cash flow, but directly distributing it to investors, they were actually up over the course of 2022. So, and then at the other end of the spectrum, you have those loss-making companies that are in NASDAQ constituents, so in the tech sector, that were down about 40%. Of course, you could look at 2021 IPOs, about 90% of the proceeds were captured by companies that are operating in tech, medical technology, data, digital, software, et cetera. And they were also down, something like 45% over 2022. So I think people have talked a lot about averages, of course, their portfolios. You had 7 mega cap tech stocks that accounted for about 30% of the S&P 500, about 11% of global market cap. So of course, everyone is going to be exposed to these companies. If they sell off, it's going to have an outsized impact on your portfolio. But these averages can be very deceptive because you saw just such massive cross-sectional dispersion. And I think the point that we were making, and that has been borne out, is that price risk from higher interest rates or other shocks, change preferences, is not distributed evenly. And there are those places, again, concentrated in growth, the focus on growth, the focus on that future profitability, that bear an outsized risk, and that I think was evident over the course of last year, but I think is still something that investors need to bear in mind going forward.
Excellent, thank you. So we are pretty much at the point of 10 minutes left. I originally wanted to also ask you to look into the crystal ball a little bit and talk about the future. I'm thinking maybe we just jump into the Q&A from the audience. I think that's probably the more important piece, and maybe there are some questions about the future there. I think you also answered a little bit in the first section that we had before. And worst case scenario here, Jason, we're just going to have to do a rerun of this sometime in the future if you're willing to do so. I'd know.
Of course, thank you.
Personally very much enjoy it. In terms of questions coming through from the audience, let me just have a quick check here to see what I can see, and then I will start asking. Okay, so the first question here, I think you hit it high level, but in terms of why is inflation so persistent, and when do you expect it to come down to target values? I guess that's a little bit of crystal ball mixed with what you talked about before.
Yeah, so as you mentioned, different origins of inflation in different geographies, but I would say what is most interesting to me and what I learned most during the pandemic is how inflation really depends on industrial and social psychology. So over the last 20 years, management teams in advanced economies were almost allergic to price increases. they thought they would be self-defeating because it would lead to declines in market share or declines in sales. So they really focused on growth, focused on market share gains, and also focused on increasing efficiencies through outsourcing, through unbundling, through leaning in on technology. So those were the growth drivers and the areas where profits were enhanced. During the pandemic, because of those shortages we discussed, businesses had trouble just meeting existing order books. So they decided to try to price ration. As new orders came in, they dramatically increased the price, and they found that they got away with it, and they liked it. Obviously, it really boosted earnings. And I think what's something that's underappreciated is that at the outset of inflation, it's not the costs or the wages or the input costs that are the problem. In fact, it's the consumer prices, the final sales price that's adjusting. So you actually had 2021 record-wide margins precisely because of all these price increases that were far in excess of the increase in production costs. This is something we also saw in 1974, where you had a material widening of margin. So inflation, when it breaks out, it takes pricing power, which was something that was a province at one point of a very small group of elite businesses, and generalizes it, makes it so virtually everyone has pricing power and increases prices. And again, those prices increase more than the cost of goods sold, costs of the input prices. And so right now, I do see businesses that are continuing to try to push on price wherever possible. Again, you have businesses that talk about, well, I increased prices by 10%. I had a 3% decline in volumes. Therefore, I hit my 7% revenue target, and are happy about this. And this sort of talk, this sort of approach is really alien to the way that management teams thought 5 years ago, for instance. And also the technology, the leaning in on pricing algorithms, price discrimination, understanding through neural network mapping the supply chains in which you operate. There are products, there are services, there are customers where you can push on price aggressively because they don't have alternatives in terms of suppliers. And so that's something where you see that you can price discriminate in ways to increase your overall revenue. And we've unlocked this, it seems. This is not going away. It's something that is going to be a more persistent feature of the economy. And it's also why one could make a strong argument that these sorts of dynamics do not end until there is a recession, and that people are finally forced to confront that they have that unitary elasticity. So every 1% increase in price then results in a 1% decline in volumes, and it ultimately is self-defeating. So this, again, it's inflation unlocks dynamics that until you actually live through inflation, I think perhaps you do not perceive.
Excellent, thank you. There's a lot of, and in parentheses, negative talk about interest rates and payments and access to funding. What have the good PE managers done to support their portfolio companies in this type of environment? And especially given that many companies probably went through a similar experience in post-GFC in 2008 and the following years?
Well, I think first and foremost, and certainly in Europe, if you look at our portfolio, it was when hedging costs were so low, both at the just prior to and then the onset of the pandemic, it was very prudent, of course, to swap out all of your floating rate liabilities into fixed rate. So in the past, it was just, again, when market expectations are for rates to remain at zero essentially indefinitely, well, you should take them up on that in the sense of, again, immediately moving from a floating rate exposure and that interest rate risk to the fixed rate. And so I think that was, first and foremost, what prudent managers did. And I think still there's opportunities today, again, as you've seen the shock to rates markets, there is now an opportunity to swap today at more attractive fixed rates than was the case 2 weeks ago or even just a week ago. And I think, again, if the more focused the market becomes on some of this downside panic scenario, the lower rates are going to go, the greater the implied probability of rate cuts. But again, you have that symmetric risk where actually the backstops, the massive liquidity injections work to stabilize the banking system, but then ultimately result in finance costs either going higher or remaining higher than previously supposed. And in that case, swapping even today would be something that helps to stabilize those businesses. Again, take the risk of those higher rates or more protracted period of high rates off the table.
Excellent, thank you. So we're almost at time. I've got so many good questions coming in here, Jason. I'm going to put you on the spot a little bit. Would you be okay if I go over just 3-4 minutes, or do you have a hard stop? Perfect.
No, that's fine.
I just want to make sure that we hit a couple of these. So one question here, or actually it's two questions that are related. With fixed income attractiveness, i.e. private credit or even public credit, increasing with the increasing interest rates, how do you think about PE allocation and deployment? And the related question, which is pretty straightforward, is now a good time to invest in private equity? How are you thinking about this? I know you yourself make a lot of the allocation decisions or within the Carlyle mandate. So how are you thinking about it within those mandates, knowing that Carlyle has both private equity, private credit, and maybe many other products? And how should investors think about private equity specifically versus private credit in this environment?
Well, first of all, I do think that investors need to be prepared for the potential for dislocations. And sometimes that could mean bank resolutions where there's forced disposal of assets. In addition, you do have in the economy today in the United States, 38% of public companies and very likely a larger share of private companies that have negative free cash flow. So these companies, I think, and they're facing, of course, very high external finance costs. So when you have that combination, you're not making money, your external finance is very high. There's also very likely to be more asset disposals as a result of that. And in some cases, they could come rather suddenly, which means that there's fire sales, again, both from the perspective of banks that have to offload loan books or pieces of themselves, but also some of those operating companies. So as a result, I mean, this is potentially a very, very attractive time, because ultimately private equity, it's about liability structures. Why did SVB have to sell those assets at a time when it would have preferred not to? It's because it had these very liquid liabilities, deposits that are always valued at par and can be pulled at any time. There are lots of other financial institutions that, of course, depend on what you could say hot money flows that can be redeemed against, money can be pulled out. In those situations, private equity outperforms because it has the liability structure, long-term closed-end funds that allow it to swoop in and make these purchases at a time when the market is short of liquidity. So I think that it's very important just to understand that the outperformance during periods of dislocation is something that is just embedded in the system because of these more durable liability structures. And so that makes it a very exciting time. In addition, I would just say that I think the most attractive piece of the credit markets today is not bonds or fixed income securities, but it is that mezzanine finance, again, to complete deals so that there's not an undue debt service burden on the companies, but then also I think to reconfigure existing capital structures, as I mentioned. So that if you're focused on the credit portion of the capital structure, I think that's where people should be focused, as opposed to thinking about fixed income bonds and particularly today, with some of the bonds and higher credit quality bonds that are expecting very aggressive rate cuts, in the second half of the year. I mean, this doesn't seem to be a time to be allocating there, given that floating rates could actually be and cash rates could be higher at year end. Again, to the extent that some of these backstops succeed in arresting this panic psychology.
Excellent. With regards to SVB, and I mean, you gave a very clear explanation before of, what was it that happened, and also covered a little bit of the specific dynamics of why was SVB especially vulnerable given the high increase they've seen in their deposits over the past few years. But even for sort of the broader banking sector that may not have gone through that same exceptional growth in deposits over the last couple of years, what are the learnings and what do you expect to see in the banking sector over the next sort of both I guess weeks for the most urgent part of the situation to maybe quarters and even years? What are the learnings and what should they be doing?
Yeah, so I think again the learning here is that when you have a rate shock of this magnitude, what you thought were these risk-free securities actually embed quite a lot of interest rate risk. And so the US system, it's not just treasuries, but of course the mortgage market is dominated by these 30-year fixed rate mortgages. This essentially transfers all of the interest rate risk from households to banks or the other holders of these instruments. And so these are kind of exotic products because they're fully prepayable. So when interest rates decline, households can refinance at the lower rates. They get that benefit, which hurts the holder of the asset because it has to reinvest those proceeds at the lower interest rates. But also, when you have situations like today, it leads to unwanted duration extension because no one is refinancing their mortgage today. And of course, mortgage origination volumes have collapsed because of higher interest rates. So the US household sector is only paying 3.5% on average on its mortgages today. But because their mortgage interest rates are so low relative to floating rate or current mortgage interest rates, that means that those losses have essentially been transferred to the banks and other holders of the assets. In the case of SVB, they scaled up their agency mortgage-backed security portfolio from about 13 billion to almost 100 billion, over this 2-year period. And so some of those assets they were holding that they acquired during that time, they purchased at a premium to par, and the market value, the bid as of last week was only 83. So the lesson here is that banks have a lot of assets that they thought were ultra safe and risk-free, but in fact, in the event of a rate shock, they carry a lot of embedded losses. Now, these losses don't matter in some sense, depending on the accounting, unless you're forced to sell them, in which case you crystallize those losses. And in the event that you crystallize those losses, chances are, and certainly was the case for SVB, you then fall below your minimum capital for regulatory purposes. And then you either need to raise more equity or, of course, you fall into a receivership in the FDIC. So this is, again, more generalizable. It is a lesson, but it's also why the Fed has taken this action. And what the Fed has done in the case, just in that example of that MBS that was trading at 83, the bank today could pledge it as collateral to the Fed at par. So it'd be worth 100. The Fed would provide that 100 of liquidity to the bank to meet its deposit withdrawals. So that precise channel through which interest rate risk leads to vulnerability in the event of elevated deposit withdrawals is if not taken off the table, it is at least now there is a backstop to ensure that the bank can obtain the liquidity necessary to meet those withdrawals. So that again, that's the key part where this is generalizable to a much broader swath of banks, but it's also important to understand the Fed saw this, recognized some of the vulnerabilities here, and has taken really decisive action to address it. And of course, as we mentioned, there's already a $300 billion increase in the balance sheet just since March 8th.
Excellent. Look, we're already 6 minutes over here. I want to be cognizant of your time and everyone else's time on. I am looking through a very, very long list of very interesting questions. So I will take that as a little note here that if you're up for it, Jason, we should do this again, maybe in a few quarters once we have a new market environment to look at and new insights to discuss. Thank you so much to everyone for joining us. I know I've really enjoyed this discussion. So thank you very, very much, Jason, also for taking the time and hopping on this call with us first thing in the morning. Wishing you a great rest of the day, and hope to see you again soon. Thank you.
Well, thanks again for having me.
A
Enjoyed our
pleasure,
discussion.
Rolly. Thank you.